In this video, traders and investors, we're going to look at the difference between active and passive investing. Stay tuned. Hey everyone, welcome to you. Okay, so active versus passive investing. What are the differences? What are the benefits? What are the pros? What are the cons? Let's take a look. Okay, so active. Active is basically the act of investing regularly, making decisions to capture short-term movements. That might not be very short-term, but it might be over a period of months or a period of years or a quarter, something like that. You're allocating capital to that. You're taking advantage of potentially a move. You're then allocating capital, taking capital out of that, allocating it elsewhere. You're constantly adjusting your portfolio, whether that happens to be going with a specific sector of stocks, whether you're moving into a commodity, whether you're trading currencies, whatever it may be. It's the way of allocating capital on an active basis. You're making decisions to outperform a benchmark. Perhaps that will be FTSE 100 or a broad index or whatever it may be. The idea is you're trying to generate a large return for your prediction, correct prediction on the value growth of the asset that you're allocating it to, or you're trying to pull it out of something you think is going to decline. You're not sitting and riding the waves. So what else we've got? You've got different asset classes. Like I say, you could trade in anything you want. You might even have property in there. You might have different funds, exchange funds that are linked to commodities. You might well have currencies in there. You might have bonds in there. You have stocks. You have high beta stocks, low beta stocks. The point is you're allocating capital to where you think the next growth area is. You're going to attempt to beat a benchmark. Generally, the guys who are trying to trade, trying an active alpha-based strategy, are trying to generate more than the return would generate than you would get if you were trading passively and you're just investing in the FTSE 100 or in the S&P 500 or whatever it was. You want to be compensated for taking this additional risk because you're diving in and out. You're changing assets regularly, you're doing a lot more trades. There's going to be a manager in that, whether it's you or it's a fund manager whose time needs to be compensated for. You're spending more on that. So the flip side of that is that you're spending more on the expectation you're going to have higher returns by doing that later down the line. Okay, so there's some risk management advantages. You can tailor obviously the strategy and what you're buying and selling to suit your individual risk requirements. So you might want to allocate a small amount of capital to tech, a larger amount of capital to utilities. You might want to flip that and say I'm very, very risk seeking and go, a large amount of capital to some sort of small cap biotech or whatever. You get the point. The point is you can distribute capital around to suit how you want to play the game. Do you want dividends? Do you want growth? Do you want this? Do you want that? And it's much more flexible from that perspective using an active investing strategy. All right, the other thing is you can tailor it to specific needs. So very similar to that. That's from a risk management perspective. If things are getting a little bit too unpleasant for you, you can pull out and move into something else. This is more tailoring to specific needs, is saying, hey, I want some more risky stuff in there. I want to do 80% higher risk, 20% low risk, 1%, whatever it may be. You can allocate it and adjust it and tweak it and have whatever flavor you like. And you can also do that seasonally as well. If you say, hey, I want to shift into some commodities because there's a seasonal tendency for those to rise, you can do that too. You can hedge as well if you wanted to go short. Perhaps not so much if this is investing, but you might be able to buy something like an inverse ETF. So an inverse ETF would gain when the market went lower. So that might be better for your risk tolerance. Saying, hey, I think this market's going to go lower. I'm going to buy an inverse ETF on here. I want to stay long those stocks. So I want to spread my risk like that. So you've got much more control over what's happening. And the final thing you've got to watch out for, which we did touch on earlier, is that costs can be a bit of a negative with this. If you're constantly trading in and out, it's going to cost you commissions every time you do a deal. It's going to cost you money. It's going to cost you management fees. It's a much higher cost. And obviously, hopefully you're getting compensated with a higher return, but that's not always the case. If the market itself is going down and you're allocating assets or cash flow to stocks, then you're going to get hit with the market no matter what, and you're going to get hit with the extra management fees. Now, the beauty, of course, is that if the market is starting to head lower, you're hopefully going to be in more defensive stocks or in asset classes that actually are going to rise when the market's lower. That's what you're hoping. But of course, timing isn't as easy as that. Hindsight is great, but in the sort of heat of the battle, it's not as easy as that. The point is you can play a bit more defensive if you feel things are a little bit more frothy. Obviously, you won't gain from any further move in a bull market if we're talking about some stocks. All right, passive. So passive, otherwise referred to as buy and hold. This is where you're not trading very often. You're literally buying something and you're not touching it. You're kind of saying, hey, that's it, I've bought it, whether that is an ETF tracker, whether that's an individual stock, whatever it may be, a Warren Buffett type thing. You've got a long-term view on it. You're holding this thing, you're not trying to gain from short-term movements. You don't care about short-term movements. You're in it for the long term. You're expecting the valuation to increase or expecting to pay dividends for the long term, whatever it may be. The point is you're there, you're holding it, you're through whatever may come, you're going to ride it out. It's a passive investment strategy. You're not trying to be clever, not trying to time highs and lows or allocate assets each where. You've put it in, you've made a decision, you stick with it. So you're not trying to time the market. You're not concerned with short-term moves. It's a long-term view. Another thing is you could do something like an ETF or a tracker. So you're buying a FTSE 100 ETF or an S&P 500 ETF, which is SPY, crude oil ETF, whatever it may be. Now, you've got to be careful, obviously, with the fees for some of these things. But generally speaking, let's say you're buying a FTSE tracking fund, for example, rather than an ETF. ETF's a little bit more expensive, but if you're buying a FTSE tracking fund, for example, it's going to cost you a very small management fee. It means you can track the FTSE 100. It's like buying every single stock in the FTSE 100 with the capital allocated according to the percentage weighting, and you're there for the ride. So you might hold that for many, many years, and it's very passive. You're not doing anything with it. You'll get some dividends from the stocks that are paying dividends. You're going to lose out on the stocks that are losing out. You're going to gain from the ones that are gaining. Overall, you're going to track the performance of the FTSE 100. Yes, you're never going to have a chance to beat the FTSE 100 because it's tracking it minus a few bit of management fees like these guys, but also you're not going to lose any more than the FTSE loses. Now, there's a little bit of misconception here that passive is generally less risky. It's not less risky, guys. Investing in stocks is risky. If the FTSE 100 halves, it doesn't matter if you're in passive or active, you're still going to, well, saying that, if you're in passive, you will lose money. You're going to lose half if the FTSE 100 half. But if you're an active, you might actually not lose as much. You might even gain money because the manager or you might have allocated capital to those things that are actually going to increase in value or decrease less than the whole broad index. So this depends on your risk tolerance. It depends on what you're trying to achieve. Depends on how much money you've got to allocate, how much time you've got, all those things to make a decision whether you want to be a passive investor or an active investor. All right, guys, stay tuned for the next one. Take care. Good trading and investing. Bye-bye.